The growth in earnings, that is profits, is the key to a rising stock market. When you buy a stock, you are buying the company's stream of earnings in the future. If the earnings don't grow, or if the market's perception of the earnings does not change, a stock won't rise. Isn't that the logical thinking for someone who's trying to assess the stock markets? It certainly is. But lately, you've been probably hearing a lot of worries about slowing earnings growth. If you have followed the recent economic numbers, they are extremely disappointing too. So everyone's wondering if the bull market could stall due to this. But today, I will show you why the most widely accepted market valuation metric, the Sensex PE, something that Dalal Street analysts and money managers track so closely, is a bad market indicator. More importantly, when you use the right metrics, you'll see immediately what the earnings really say about the stock markets. Earnings growth should move closely in line with stock prices. But in recent years, that's not what has been happening. So, the fear that poor earnings growth could be a drag on Indian stocks and could halt the rally is hardly exaggerated. The initial euphoria of the corporate tax rate cut boosting earnings has also waned. But recent IPOs have shown that the market is flush with liquidity, and the Sensex just touched a lifetime high. So, what most investors are worried about is that 2020 could begin with the bursting of a big bubble in the stock markets. The fact is that earnings growth comes with a lag. In some sectors, earnings are cyclical. In others, there's a strong correlation with the investment activity in infrastructure and capacity utilization. Now, over the past decade, most of the Sensex stocks, quite a few of which are consumption-related stocks, have done fairly well in their earnings performance. Naturally, their valuations too have surged. But slow economic activity, particularly manufacturing activity, has failed to lift the earnings of most non-Sensex blue chips. And over time, this earnings gap has led to a huge valuation gap between Sensex stocks and non-Sensex blue chips. So say an Asian Paints or a HUL was valued at 40 times earnings 5 years back. They're valued nearly at 60 times now. Of course, these companies have been pretty consistent with their earnings performance. But can their valuations sustain? To answer that and to consider what could happen in 2020, let's look at this chart. It shows the growth in net worth and market capitalization of Sensex and non-Sensex blue chips over the past decade. The reason I've taken net worth instead of earnings growth is to avoid the impact of cyclicality. And what you can see here is that while the Sensex is fairly valued, the non-Sensex blue chips have a fairly good upside in terms of their valuations, which means 2020 could be very different from what most investors expect. And here's what the Sensex lifetime high is not telling you. A bulk of the upside in 2019 has come on the back of a few 8 to 10 Sensex stocks. So it's quite possible that a temporary pullback in liquidity could lead to a temporary correction in the Sensex stocks. Especially with big IPOs lined up in 2020, early months of 2020, a liquidity suck-up cannot be ruled out. But more importantly, the non-Sensex blue chip stocks could bring in the surprises. By non-Sensex blue chip stocks, I mean stocks that are part of the BSE 200 index but not in the Sensex. These are the stocks that could enjoy a fairly long runway of earnings growth and improvement in book value. And the upside in their valuations could be substantially larger. So instead of being too focused on what the Sensex has to say, I would recommend looking for safer and consistent bets outside the Sensex. To know more on this, please subscribe to the 5-Minute Wrap-Up. Thank you.